This is the Daily Market Comment by Harlan Bisuros. I'm Maria Pachurdes. Thanks for joining us at XM.com. The US dollar traded lower against all but two of the other major currencies on Wednesday, with the exceptions being the Canadian and New Zealand dollars. With no major US data to drive the US dollar, it seems that traders continued adding to their short positions based on the divergence between ECB and Fed expectations. On top of that, the BoC's decision to hike by 25 basis points and signal that it would likely stop raising interest rates while it assesses the impact of cumulative hikes may have added to speculation that the Fed is also headed towards the exit. However, next week's meeting seems too early for the Fed to signal a pause. According to the Fed funds futures, investors are almost fully pricing in a 25 basis point hike for next week, but they see another one of the same size being delivered in March. Today, traders may turn their gaze to the first estimate of US GDP for the fourth quarter. Expectations point to a slowdown to 2.6% quarter-on-quarter from 3.2% in the third quarter, which is still a strong pace of growth. However, with retail sales weakening sharply over the last 2 months and the manufacturing and housing sectors in recession, this could be the last quarter of solid growth before the lagged effects of the Fed's prior supersized hikes are felt by the economy. The fourth quarter numbers may offer guidance as to how weak upcoming quarters could be. For example, a downside surprise could work against expectations of a soft landing and instead ignite fears of a deeper recession. In such a case, the dollar is likely to stay in a downward trajectory, especially against the euro. Following President Lagarde's hawkish remarks at Davos last week, more hawkish comments by ECB policymakers, combined with further improvement in euro area activity and accelerating core inflation, are likely to keep the common currency supported. Euro-dollar closed Wednesday above 109, increasing its chances to challenge the 111.75 zone in the not-too-distant future. The Canadian dollar was the main loser yesterday, coming under strong selling interest after BoC policymakers signaled that they will likely take their hands off the hike button as they assess the cumulative impact of prior rate increments. Having said that, though, the next part of their guidance said that they are prepared to take interest rates higher if needed to return inflation to target. This suggests that they have not fully closed the door to more rate hikes. This is today's Daily Market Comment. Thanks for joining us at XM.com.